Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, Tim Miller. G'day, Tim. How are you?
Yeah, going well, Aaron. How are you doing?
Not too bad, thank you. Well, we're beyond our SMSF insurance masterclass that we've held this week, and probably the area that had the most interest and conversation about was our future service deduction. And importantly, Tim, in our masterclass, we really put that at the forefront of conversation where historically people kind of look at it in the event of death and work out whether the tax deduction may or may not be relevant in those circumstances. But we highlighted why and how many other opportunities there actually are to consider this in lieu of the actual premium that can be paid. So can I get you to just elaborate on that a little bit more, and then let's maybe jump into how we applied that as part of our Little Brewers superannuation fund.
Yeah, so look, what we know and appreciate from a superannuation point of view, and particularly for self-managed superannuation funds, is that we have to consider whether to hold a contractor insurance over the members of the fund. And the insurance that we can consider is that of death, TPD, terminal illness, and temporary incapacity. And now these four conditions of release align with the ability to claim a tax deduction on the premiums for those insurance-based policies. And for the most part, most super funds will claim on an annual basis the premiums that they pay. However, those same four conditions of release and those same four insurance policies are also claimable under this concept of the future liability to pay a benefit deduction. So that is Section 295-470 of the Income Tax Assessment Act, where what the fund would do is, instead of claiming on the annual premium that's paid, it claims on the benefit attached to the payment that is made when one of those events actually occurs. So if we have a death event, if we have a TPD event, a terminal illness, or temporary incapacity, we can forego the deduction on the premium. So we can make an election, and indeed we have to make an election not to claim a deduction on the premium, and instead claim a deduction based on the actual benefit payment itself.
Yeah, so that specific choice sits within 295-465-4, and that becomes a permanent decision. So it is an important decision that needs to be made at a particular time, subject to the insurance event or the event of death that ultimately happens within the fund.
Yeah, and if we look at the history of this deduction with reference to, say, the ATO and their view on it, it's one where you must have premiums being paid in a year, and then you must have the ability within the year, and generally the year that the event occurs, to be able to say, right, well, we're not going to be claiming on the premiums this year. Instead, we're going to claim on the benefit payment itself. And so it ultimately requires one thing first and foremost, and that is that in the year that an event occurs, right, that there must have been a premium paid, which certainly from an administrative point of view gives credibility to the idea of paying monthly premiums versus annual premiums.
Yep.
Because if you don't pay a premium before the event, then you don't have the capacity to make the election.
Yeah, and therefore, and we spoke about this throughout our masterclass, those different events can trigger different outcomes. So when we think about the temporary incapacity, we have a very different set of circumstances in that situation where and how the calculation applies. That in that instance where we had, using Kathy in the example as part of our Malthouse family, there was no real benefit in actually looking to that alternate method in the future liability claim. Whereas if you compare that in a situation whereby we had Kathy maybe moving to permanent disability or a TPD claim, that provided a very different outcome, that all of a sudden the ability to claim that future tax deduction as opposed to the premiums certainly came to the fore once we considered her age and the level of benefit that's attached to it.
Yeah, and look, I wouldn't say that you would never claim this 295-470 deduction from a temporary incapacity point of view, but the circumstances would need to be relatively unique. So maybe a single member fund where that person was approaching age 65 and had a temporary incapacity element there, and so it may be able to offset a significant deduction for a very short period there. But because the temporary incapacity deduction is based on the amount of income that's actually paid in that first year, you might be in a situation where you've only paid 1 or 2 months worth of income from a timing point, and that deduction is not going to be beneficial comparative to, say, the premium deductions that are being paid on behalf of multiple members within the fund for their various insurance policies. Because we've got to recognise that once you've made that election, then it's irrevocable and you can't then claim on the premiums, not just for that member, but for all members of the fund at that time and all members of the fund in the future.
Yeah, which raises the next interesting point, because the legislation is very clear on that once that choice is made, you are basically continuing to go down that road with no ability to undertake any deduction for premiums going forward, as you've already indicated. Now, our Malthouse family is a very unfortunate family because we've had multiple events that have occurred within that family where we not only had a TPD claim, but we then ultimately had issues around terminal illness and even death. So it does raise a really interesting point at this juncture here, because if we are then working down a particular path, i.e. the claim under 295/470, rather than the ability to claim the premium, it then does raise the question about claiming that deduction on another event that may occur, whether that's once, twice, 3 times, and so forth. And ultimately there, we don't have any real guidance other than looking specifically at what the legislation says, that effectively says, well, you can't claim a premium deduction, so therefore you fall into the ability to claim a future service period. But we don't know whether that is it one time, or just does it allow you to, because you're going down that path, that if you do have other events, it would entitle the fund to a further claim under those provisions.
Yeah, and look, and I think that it does, as you say, raise a really interesting sort of outcome there, because particularly, and you might not see it in a 2-member fund because you might not have insurable events that all occur before other members turn 65 or whatever. But if you've got a multi-generational fund where there is a potential of events occurring before multiple members turn 65, which is one of the criteria of the future liability deduction, then there looks to be that scope to be able to claim the same benefit-based deduction on future events. But as you say, it's not something that's been ultimately tested with the tax office or clearly promoted previously.
Well, I think, Tim, we could probably talk about that for some period of time, but the idea around, I guess, bringing this to the forefront of discussions with clients around insurance inside SMSFs is certainly something that our attendees got great value out of as part of the SMSF Insurance Masterclass. So we have produced some documentation, obviously, around that future liability deduction claim. So we are looking to add that onto the Smarter SMSF platform for those that want to utilise that strategy around whether it's temporary incapacity, permanent, terminal illness, or death. And I guess most importantly, if you want to find out more about these masterclass events, they will be a key feature of our 2025 CPD program as well. So you can find out more on our Smarter SMSF website, smartersmsf.com. Thanks once again, mate. Good to catch up.
Always a pleasure.
Okay,
Cheers.
Thanks everyone, and bye for now.
Bye.